The main topic of this week's video is stock market consolidation. Does it favor a big move up or a big move down? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We've got a lot to cover this week, so we'll be moving quickly. The topics: what can we learn from recent stock market behavior? We'll look at some long-term consolidation, a bearish example, a bullish example, and the recent long-term consolidation in global stock markets. Take a short-term look at the S&P 500, ask what can we learn about the present day relative to the past from a market leadership perspective, briefly touch on a study about the Fed's effectiveness, touch on asset class behavior in recent weeks, the recent improvement that we can see on the chart of the S&P 500. It should be noted that when we sit down each Friday and put together these weekly videos, the model's readings, which are based on the facts that we have in hand, are the starting point for what appears in the videos. So the videos basically back up the case that's already being presented by the evidence that we have in hand. Sometimes it's very, very difficult to keep an open mind about the bigger picture when we solely focus on daily charts. Here are two periods, similar periods from history that we'll use for illustrative purposes. I've taken the dates off to remove bias. Notice they have a lot of similarities. We have a sharp decline. Our moving averages have negative slopes. RSI drops below 50 in both cases. We get somewhat of a double bottom or a W formation in each instance. In this case, the blue 50-day moving average starts to turn back up. The blue 50-day starts to turn back up. MACD comes from below zero, gets a bullish cross and recaptures the center line, RSI moves from somewhat of a tepid profile back above 50, clearly between 50 and 70, and price is making a series of higher highs and higher lows, and it goes from being below all of these moving averages to being above all of these moving averages. This chart here is similar to this chart here, but it does look a little bit stronger. These candles here are probably more attractive than these candles overall here. We have some really strong candles here, but we also have some hesitation. This looks pretty good in here, so we'll give this side the benefit of the doubt. The chart on the left, here's the date down here, May 2nd, 2008. The chart on the right is roughly a week ago, Friday, March 18th, 2016. Here's point A, and then it's fair for us to say after a W formation and all of this improvement that we just talked about, what happened next? The counter trend rally ended here. This is point A. This is where we were looking on the previous slide, and then the primary trend resumed, which was down. Is the purpose here to say that's what's going to happen next in 2016? Absolutely, positively, no. The purpose is just to say that it is common for a daily chart to improve, moving averages to improve, breadth to improve during a counter trend rally. It also should be noted that these candles do look good here, and as we've said for the past few weeks, the bulls still control the tape and the bears still control the primary trend. So the bears have some work to do. The bears need to recapture the tape, something that they haven't done yet, which tells us to keep that always important, flexible, unbiased, and open mind. Since these charts tell us that it's difficult sometimes to discern the bigger picture within the context of improvement on a daily chart, what happens if we take a step back and look at consolidation, two periods of consolidation, one that had bearish outcomes and one that resulted in bullish outcomes? Another logical reason for taking a step back to 30,000 feet As we've discussed in past videos, if we zoom in on the S&P 500 and use a 60-minute chart, it becomes very, very confusing at this level. The main portion of the video is going to look at a global stock index, and there's a reason why we're doing that. We don't want you to say, I'm going to turn this off because I don't trade the global stock index. It's very, very relevant to the S&P 500. As you can see here, from 2007 to the end of the bear market in 2009, the two indices, the FTSE All-World Index and the S&P 500, were very, very highly correlated, and that's still the case today. Their correlation very rarely drops below 0.5 and typically is much higher than 0.5. The global index peaks here. The S&P 500 starts to drop after that. Counter trend rally ends here. They basically end on the exact same day in the bear market, and we could do the same thing for the current bull market. Do they diverge from time to time? Yes, they do, but they're extremely highly correlated and tend to zig and zag together. The reason why we want to examine this index relates to something that we touched on in last week's video. Remember, in last week's video we said in the spring of 2015, the ETF scoring system and the model, it was very, very difficult to find any asset class or any ETF that was outperforming the S&P 500 or a handful of U.S. stock-centric ETFs. Why is that relevant? In the prior bear market, 2007 to 2009, and we're not saying that we're in a bear market now, we're simply saying we remain in a downtrend, but this point is still relevant. During the financial crisis bear market, it was not the S&P 500 that was the global leader. It was emerging markets, or EEM. You can see two things on this chart. In the early stages of the bear market, the S&P 500 makes a discernible lower low here. The global leader makes a higher low. And if we look at the slope of this line from point to point, this is a more pronounced and steeper negative slope than this slope is here. Emerging markets were the global leader, and the point of the exercise is they were still highly correlated with the S&P 500, and they may have held up better than the S&P 500 in the early stages of the downtrend, but eventually the divergences typically will start to close, and in this case, the S&P 500 dropped and emerging markets dropped basically in unison. We could probably expect the same thing if the FTSE All-World Index in the present day rights itself and goes on to make higher highs. Most likely, good things will happen with the S&P 500 index. Conversely, if the FTSE All-World Index continues with its current downtrend and goes on to make lower lows, the odds of bad things happening in the S&P 500 will increase. Having said all that, let's look at the bigger picture from 30,000 feet. Now we're looking at a daily chart of the FTSE All-World Index, and I might add that all-world means part of it is the United States. A good chunk of this index is U.S. stocks, so they are included here. We're looking at stocks all over the world. This is 2014 here, February, and this is the present day as of Thursday, March 24th, 2016. The first thing that jumps off this chart is the FTSE All-World Index is clearly in a downtrend, resistance, 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 resistance. We just came back up off of the W formation, and we have now reversed at a logical level. This is as of March 24th. Also, remember we said that they were highly correlated, and in the last bear market, emerging markets held up much, much better than the U.S. In the present downtrend, the United States is holding up much, much better than global indices. This decline here reached bear market territory. This is a 20.78 decline from peak to trough here, and you might counter with, well, we've retraced that and we're no longer in a bear market. Well, that assumes that the downtrend would be broken and we would move in this direction. If the downtrend continues, then the odds say that we will go on to make a lower low, and this number will get larger instead of smaller. Obviously, that is to be determined. There's something else that we can learn. This just isn't a chart with a bunch of lines on it. Global stocks have made 6 discernible lower highs. It's possible that this will be the 7th. That also is to be determined, as well as printing 6 consecutive lower lows. This is a downtrend, and if the downtrend were to continue and this 7 holds, there will be another 7 that will end up being lower than this 6 here. Again, that is absolutely to be determined, but it's undebatable that as of March 24th, this index is in a downtrend. It's not in a range. It's not in a consolidation pattern. It hasn't made a higher high since mid-year 2015, and it just made a new lower low on the daily chart a few weeks ago. All of this is subject to change, but the model allocates based on the facts that we have in hand. Also, again, this isn't just a bunch of lines on a chart. This is telling us that bearish conviction relative to bullish conviction is getting stronger and stronger. It's getting more and more difficult to push to a higher high, and when we sell off bearish conviction, the strength relative to bullish conviction can be seen by the fact that we're making lower lows. This chart contains the net aggregate opinion of all the fundamentals around the globe: earnings, valuations, Fed policy, geopolitical events. When the net aggregate opinion is bullish, stocks rise. When the net aggregate opinion is mixed, they tend to go sideways. And when that net aggregate opinion of all the fundamentals turns and flips to net pessimistic or bearish, stocks tend to fall. And if we strip away noisy price and only focus on the 200-day moving average, we get a relatively clear picture of a market that had a bullish bias, then became somewhat indecisive. And now, based on the facts in hand as of March 24th, we have a clear and discernible bearish bias, and that will be in place, and that's how we will allocate until the evidence changes. When will it change? We have absolutely, positively no idea. All we know right now is that we're in a global downtrend. We don't know how long it will last. We don't know if we'll move into bear market territory in the United States. We don't need to know that, because if we don't, then the evidence will improve and the model will make the necessary adjustments. Now let's go back to 30,000 feet. So this is the same indice that has a very, very high correlation to the S&P 500. This is back in the spring of 2004, and this is the year 2011 here. I want to emphasize again, the purpose of this exercise is not to say that this is what's going to happen next. The purpose of the exercise is to discern between a bullish uptrend and a bearish downtrend. You can see here we have a bullish upward sloping trend line that basically contains price and acts as support. Whenever there's a pullback, we have a tendency to stay above the red line. And regular viewers and clients know that we need 3 things to happen for a trend change. Step 1 here is we break a trend line. Step 2 is we make a discernible lower high. This high here is discernibly lower than the previous high here. And then the trend change is confirmed from a probability perspective when we make a discernible lower low. This low here is lower than the previous low, telling us now that the probabilities favor, instead of a bullish uptrend, a bearish downtrend. It doesn't tell us anything about how long the downtrend will last, nor does it tell us anything about the magnitude of the potential losses. A downtrend is a downtrend. When we are in a downtrend, it is not a good time to put our hard-earned capital at risk. Once the downtrend flips back, the odds become more favorable. We can also see the concept in real life of what once was support may now act as resistance. It's very common to go back and retest a broken trend line. It's very common to go back and retest a broken trend line. What once was support may now act as resistance. This is the same chart as of March 24th, 2016. As we've noted in the past, the market model doesn't use trend lines because they're somewhat arbitrary. We can draw all kinds of trend lines here that have been broken. Point of the exercise, this is a long-term trend line here. Here's step one, we have a broken trend line. Step two, we have a discernible lower high. This high right here is discernibly lower than the previous high. And step three, very, very similar to this period here, we have now made a discernible lower low. This low here is discernibly lower than the prior low here, and now we have a confirmed downtrend from a probability perspective. Probabilities tell us that even the lower probability outcome is possible out of any formation or probabilistic setup. That's why we're constantly using the terms probability or odds. It helps us keep an open mind about all outcomes, including a sharp reversal and a new sustainable bullish trend that could begin at any time, including next week. Now let's hit the main topic of the video, consolidation. What is it telling us? What can we learn from it? We have sideways consolidation here. Price is in the exact same place here as it was several months back here in the year 2007, and in the present day we have a very long-term period of sideways consolidation. And in each case you can make an argument that we have somewhat of a topping pattern with a left shoulder ahead, a right shoulder, a left shoulder ahead, and a right shoulder. We will use this as a reference point. Here you can see on the left shoulder, once we're inside the box and we come down, let's use this point here as a reference point. It's very, very similar to this point here. In both instances, and before we talk about this, it is irrelevant if this is a head and shoulders pattern or if this is a head and shoulders pattern. It's price, and it's still making a lower high. Notice the area that could be a right shoulder is making a discernible lower high relative to this previous high that we could call the left shoulder. The exact same thing has happened in the present day. This run up here is quite a bit higher than this rally attempt here. So regardless of what this chart pattern is, that tells us something about the battle of bullish conviction relative to bearish conviction. The bulls carried a heavier weight here. Now the bears have gained some ground. The bulls had some traction here. On a relative basis, the bears have gained some traction between these two peaks. Remember, we said we wanted to use this point here and this point here as a reference point. In both instances, price went on to make discernible lower lows relative to our reference point. In the present day, price has gone on to make two discernible lower lows relative to our reference point. If I could take questions from the audience right now, I'm guessing someone would ask or point out, Chris, you're cherry picking, you're ignoring the largest consolidation period on your chart. And I'm glad you asked that question because it's going to help us illustrate the main points. How do these periods compare to what is a very similar look here? We've got a left shoulder, a big head, and a right shoulder, and a very long consolidation period. We know from past videos that the longer a market goes sideways, the bigger the move that we tend to get. The longer a market goes sideways, the bigger the move that we tend to get. We also know from those two examples that when we go sideways, we don't know, or we don't have to know, which way the market's going to break. This consolidation period could have had an outcome similar to this one and gone in this direction. In this case, it was down. In this case, it was up. So a fair question would be, if this period and this period look similar, how does this period, which had a bullish outcome, compare to this period that had a bearish resolution? And if you're a client, I want to emphasize again, the model doesn't use any of this. What we're talking about here aligns with the model. The model and our allocations are based on numerical scores. They don't have anything to do with this, but that math is capturing everything that we're talking about. It's just capturing it mathematically and using indicators and risk-on, risk-off ratios. It tends to paint the exact same picture that price paints. One of the reasons why we use the model, it is difficult to discern sometimes when you have a pattern that looks like this, that goes straight down, and one like this that goes straight up. The model can help us with the bias that we have when we're here and the bias that we have when we're here. And our current allocations already reflect the bias in the math here. Could this math improve? Yes, it could improve. So let's look at this box and compare and contrast this one to these two. Unlike these periods where this peak here was discernibly lower than the first peak, this peak here is discernibly lower and weaker than the conviction for this peak here. In this case, it's just the opposite. The conviction in our pseudo right shoulder here is higher than it was here, telling us that the battle between bullish and bearish conviction between this point here and this point here, the bulls are the one that have gained ground from this point to this point. In this case, the bears are the ones that have gained traction over time. In the present day, the bears are the ones that have gained traction. We have another significant difference. Remember, we said we wanted to use the pseudo left shoulder, this low as a reference point, this low as a reference point. That would be this low right here. Instead of making two discernible lower lows, we can observe these lower lows relative to this low here. We can observe these lows relative to this low here. In the bullish case, we made two consecutive discernible higher lows. This and this and this really doesn't look anything like this, and this and this and this really doesn't look anything like the present day. What can we learn from that? The only thing we always learn from all of this, it just helps us with probabilities. The facts that we have in hand now, including the readings for the model and asset class behavior that we'll cover a little bit later in the video briefly, still align with this type of look relative to this type of look. Does that mean something like this is going to happen? Absolutely, positively no. All it means is that it aligns with a downtrend. And we have no idea how long that will last, but this doesn't look good still after a 5-week rally. But after 5 weeks, it has to be different. Well, this is a 2-month rally if we look at the S&P 500 here. None of this tells us anything about what's going to happen next, but we're very confident that it's telling us this is not a good time to put our hard-earned capital at risk. And that even includes if we miss upside. It's still not a good risk-reward proposition for our hard-earned capital. And remember, this is a laggard relative to the S&P 500 in this downtrend. And also remember, it's not likely that these two indices diverge for long periods of time. Can they diverge for short periods of time? Sure they can. And if we took the attitude, if we owned emerging markets in 2008, that emerging markets are different than the S&P 500, and I don't really care what's happening over here because I own the leader. Eventually, in this case, if the downtrends continue, they'll come get the leader as well. So this looked like a bear market here. This looked a lot better. At the end of the day, they both looked like bear markets. Again, none of this represents a prediction about how 2016 will play out. And just as emerging markets did a lot better than the S&P 500 during this period, it is quite possible that the global leader, which was the S&P 500 and a handful of US-centric stock ETFs, these are the global leaders. It would not shock us if they also outperformed in the present day as emerging markets did during this period here and went on to print a new all-time high. Is that probable? Probably not. Is it impossible? No, it's far from impossible. And there's a good narrative to say that we should keep an open mind about that. And as I mentioned last week, what would we do differently? We wouldn't do anything differently. We would do what we do every week. We would look at the hard data and we would make the adjustments that we need to make based on the changes in that hard data. We know that the S&P 500, the global leader, did take out some of these fibs, and I'm guessing if we looked at emerging markets, they probably did the same thing in the financial crisis bear market. How about the NYSE composite? This is our peak, this is our A, this is our B, this is our low. We retraced right into the meat of the fibs and basically closed here on March 24th. This is as of 3:14 p.m. right at the normal and to be expected retracement within the context of an ongoing downtrend. Now we've added some generic and widely used and even number weekly moving averages, and you can see the trend here is rolling over. How do these moves here and this rollover here compare to what's happened in the recent past? If we move back out to 30,000 feet on the NYSE Composite Weekly, this is the year 2005 where my cursor is. This is 2016 here. Two takeaways. First of all, Chris, the moving averages are rolling over here. Well, we just noted recently that the global indices, that this period here looked better than this period here. Also from a fib perspective, this is my peak, this is my intra-week low, my closing low is up in here. If I take the high to intra-week low fib during this rally here, we clearly exceeded the 61.8 retracement from A to B, and then when we came back down, we basically held at the 38.2% retracement. How does that compare to this period here? Here, we did what we would expect in a downtrend from a textbook perspective. This is my A, this is my B. We stayed within the fibs and moved all the way back to the 61.8% retracement. This period here looks more like this period here than this period here. Is it possible that this is the outcome that we have in store for 2016? Yes, it's possible, and we're open to that. Notice, if that happens, the data won't miss it. Look at the slopes of the moving averages here before the big rally comes. We're basically moving sideways here. This is where the big move comes. When the big move comes, prices above all the moving averages, blue the fastest is on top, the slopes of all the moving averages are up. That is in stark contrast to what we have here. Blue, the fastest moving average, is on the bottom, and the slopes of all of them are down. We have not exceeded the retracements. Here, we're well above the 61.8% retracement, simply helping us with nothing more than probabilities relative to future outcomes, a wide range of future outcomes that include wildly bullish outcomes and horribly bearish outcomes and everything in between. We showed this chart on Twitter. It helps us with the primary trend and counter trends. This is the 21-day moving average. We've taken noisy price out of the equation. You can see the 21-day is in a bullish trend. It's making a series of higher highs and a series of higher lows. We flip over just as the market starts to flip over in the spring of 2015. And now the 21-day is in a downtrend. The primary trend is down. Instead of making higher highs and higher lows, now we're making lower highs and lower lows. This is a counter trend rally within the context of a primary trend, which is up. This is a counter trend rally. This so far looks like a counter trend rally within the context of the primary trend, which is currently down. This is a chart that we've shown before. If we attach this high and this high, you can see we stopped in a relatively logical area. You can make an argument that this is a failed bullish breakout. That's to be determined. We don't know. If we move above here, is it possible within the context of the downtrend to move up to 2100? You bet. Well within reason. If I attach this high, this high, this high, and this high, which basically says this trend line is more relevant than this trend line because it touches price more often, we could still move all the way up to 2100 and not much would change from a price perspective. If we exceed 2116, then that's no longer the case. Now we've made a higher high and the model would catch that, the data would improve, and then our balanced outlook would start to become much more balanced because we would have hard evidence that would put the downtrend in serious doubt from a mathematical perspective. When all the ballots were counted after the close on Thursday, March 24th, the S&P 500 closed just a little bit below 2036, which means you can also make the case that we have a failed bullish breakout relative to this gap here. If you know technical analysis, you know that sometimes when you get a failed breakout, bad things happen in this direction. To offset that, the bulls still are in control of the tape until proven otherwise. So the bears have some work to do heading into next week. And on Friday, when the markets are closed, we have a GDP announcement that could impact next week. On March 13th, we tweeted a weekly chart that showed several areas that might act as a trend channel. If we fast forward to Thursday, March 24th, looking at a weekly chart, you can see we came up into a logical area here and stalled, and we've got somewhat of an indecisive doji look near possible resistance. However, if we look at a high-low close, it also leaves the door open for gains up again near 2100. So when we head into next week, obviously we will do so with an open mind about all outcomes, especially in the short term. In this video, we've discussed that the model is still saying, be careful. The charts that we've covered, especially the longer term charts, are also saying, be careful. What happens if we look at asset class behavior? To get those answers, there are 16 charts on this See It Market post from this week, and you can Google this title, my name, and See It Market. I'm sure you can find a link to the post, or just go to See It Market and find it. A little follow-up on the three legs of the stool concept, Bloomberg Business. If you Google this title, you can find the entire article. It's a study about the effectiveness of the Fed. Betting on the Fed's ability to generate continued market levitation seems like a dangerous game to us. When we take a step back, sometimes it's easy to forget the day-to-day emotions and the psychology that wraps itself around trading and investing. If you were in the markets in this period, or if you were in the markets during the dot-com bust bear market, you remember that we had a very similar dialogue going on here, with many people saying we have a topping pattern, and then we had a sharp counter trend rally where all of the people that thought bad things were going to happen had a miserable few weeks in here, and eventually the primary trend resumed. Is it likely that we get a plunge like this again? No, I don't think it's likely. This is a very, very rare event here. The only thing we know, and we've said it several times, we know we have a downtrend in place. That's all we know. That's all we need to know. We don't need to be in the gloom and doom business. If things improve, the math, the model, and the charts won't miss it. All we have to do is continue to pay attention with that flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.